Most real estate entrepreneurs never make it past their first deal. It's not just I can raise the money. It's all about the experience, the know-how, how to pick the right property. Today, we're going to be talking to Gabriel Craft. He is a real estate syndicator, and right now he's looking at a 260 unit apartment complex that he loves. And I'm going to let him explain to you why, and so you can get a deeper understanding of what to look for if you're trying to buy real estate yourself.
All right, Nate, thanks for coming. Really excited to show folks our due diligence. I'm Gabriel Craft. I'm the CEO of Craft Capital Investments. Me and my business partner, Aaron Katz, got under contract on this lovely property called Tower Village. We're located in Las Colinas, Irving. So it's a fancier area in Irving, just a little south of the University Hills area, across from the University of Dallas. So I'm pointing because literally across the street is where thousands of students go to school at a $70K a year tuition school. So normally I'm buying C-class assets like this. This is definitely a C-class. Definition of that for me would be 1970s build. You've got messed up electrical, messed up plumbing that you got to go in and fix. It's where I feel like there's the biggest bang for your buck right now in terms of buying and rehabbing apartment complexes, but it's also the most work. And it means that diligence on these properties is literally like mission critical. You have to find everything and make sure you're not paying too much right out of the gate.
What's the difference between a class A, class B, class C? What does that actually even mean?
I love the jargon that we use in our industry. Class A, that's like a nice brand new property in a great location. Class D stands for do not buy. That would be like buying in the hood. Okay, that's buying in the hood, and I've done that before, and my first two apartment complexes, but you usually don't make money on those. So we like to buy somewhere between class C and B. What I'll point out is there's really two parts of every classification, right? You've got the neighborhood. What class is that? Is it a high-end neighborhood where everybody's making $110,000 or more median? Maybe $80,000 or more would be class B. 50 and higher, I like to call class C, and everything below that, it starts to get to that C minus D plus range, kind of in the hood where they really can't even afford rent bumps, right? That's the neighborhood. I don't buy in class C neighborhoods anymore. Actually, I buy class C assets. So the property itself, and the definition of that is A would be a new build, anything maybe 2000, 2010 and newer would be considered an A-class physical asset. B is going to be somewhere between 1985, that's an important critical cutoff, and early 2000s. A Class B asset is going to have PVC piping and usually individual water heaters and pitched roofs. That's what we would consider to be sort of the more modern technology that you see people adopting all through that year range that I gave you. Before 1985, they had a lot of weird things going on in the 60s and 70s. So they were running out of things like copper and replacing them with aluminum. So you have bad electrical systems that have aluminum wiring that you need to replace. They were using galvanized pipes for their plumbing in the 70s and the 60s. So you get underneath the ground and you realize, well, there's a little chemical reaction going on. And so the pipes are looking like peanut brittle a lot of times on the sewer lines. And so Class C, it would be pretty much anything 1985 and younger, and D just means it's been taking a lot of a headache and a beat up.
Why do you like this property?
Okay, there's four things that stand out, but one of them is way more important than all the others, and that's the location, right? You cannot change your location. When you're buying apartments, you've got to remember that you can only participate in the market. And so we just talked a little bit about Class A, Class B, but you've really got to think about the location part of it. And me and my business partner, Aaron Katz, started looking at better and better locations. And what we decided to do is just have a very narrow definition of that. We want B minus or higher on niche.org for the school district. We found that good schools and older assets result in stickier tenants. They don't want to move. You know, maybe they got that job and they're living with their sister and the sister loses her job. Well, they'll still find a way to pay that rent. If they're in a bad neighborhood and the school sucks, they don't mind moving their kids. So they'll figure out, they won't figure out a way to make the rent payment happen. So we like this location because these are some of the best schools in all of DFW. Irving, and where we're at in Irving feeds into B's and A's on the niche.org kind of scale of things. And it doesn't mean it's a great school. It's not like a private school, but it's a school that workforce housing folks love to provide for their children and will work harder to kind of stay at. The other thing is median income. So this spot's got a 57 1 mile and a 72 3 mile median income. Don't use average incomes. Average incomes are like well over $100,000, but rich people can skew that up real high. Lots of $1 million houses around here, lots of gated communities around here. The location is clearly just a beautiful asset right across the street from a good school, right near a part of DFW called Las Colinas. Las Colinas is what I would consider to be where the higher end jobs are. You've got the headquarters for Kimberly-Clark. You've got the ExxonMobil headquarter over here. You've got Wells Fargo building a new tower, and Goldman Sachs is moving to town. So there's some really big employers. Oh, DFW Airport. For all the blue collar folks that actually live here, we have a lot of employees of DFW Airport here. And you kind of get a qualitative feel too when you visit a property. This property is absolutely gorgeous. Instead of being squeezing 264 units on one maybe 3 or 4 acre property, it's 9 acres. It's expansive, and as you'll see as we walk through it, it's got plenty of room for a dog park, a fountain, a gym, a pool, playgrounds, lots of grill, cookout areas, a volleyball court. So we really liked the space and the vibe and the unit mix. So the unit mix has been mission critical. The unit mix ended up being probably the biggest financial metric for us, because they have 82% 2s and 3 bedrooms right now, and they're all very large. Since the sellers aren't standing here, what we found today during diligence is that the few 1 bedrooms they have can be converted to 2 bedrooms with about $1,500 worth of drywall and a door. The 2 bedrooms, some of them can be converted to 3 bedrooms, and their 3 bedrooms, some of them can be converted to 4 bedrooms. That means
Is that normal?
No, not the way they have it set up. What they have is this outdated layout where they have a dining nook that doesn't count as a bedroom. And what we noticed when we did diligence is that many of these folks here are students. There's a really great school right across the street. They're already using that dining nook as a bedroom. They're just putting up a shower curtain. If we throw up a real door and a wall, get the city to recognize the bedroom, then we can actually charge $250 to $300 more.
So we're walking around the property and really figuring out how to increase the value of the property, not just from expecting a 2%, 3% annual rental increases, but actually bringing these units back online that have been taken out of the rental pool by taking the 1 bedrooms, turn them into 2 bedrooms, 2 bedrooms into 3 bedrooms. All of that is increasing your rental rate beyond just that annual increase. Because let's be honest, at the end of the day, that 2 to 3% annual increase in rents that everybody expects is not going to bring you a 20% annualized return. But once you start thinking about how to increase the rents beyond just that natural market increases, then there's some real opportunity there, and you definitely see that around this property. Since there's a school right next door, would this be considered student housing, or this is just...
It's really fascinating. This used to be student housing. 10 years ago, the people who own it now bought it from the university. It's actually not very many students. It's about 30%. That's what we're finding on the rent roll. About 30% of these units are students. The other 70% is workforce housing. I'd say about 40 to 45% of that is hardworking Latino families that are got really good jobs here in the DFW area. The other portion is just an other category, because man, I met everything from a 93-year-old guy with his hot young 87-year-old wife, and we ended up getting wrapped into a very long conversation because it was wonderful. Everything down to, just youth, like 21 and 22-year-olds with their first full-blown apartment together. So it's a really pretty opportunity from a financial perspective. But the third area that we liked the most is there's a lot of value out here. It is ugly. Look at it. That is Pepto-Bismol pink on that side, okay? And then if you go to the other side, you've got barf brown and a terrible stucco job. And that's where our expertise with these older properties comes in. We bring an army of vendors who are out and about, spread around right now, taking a closer look at the asset. And we figure out, using some designer help, what we could do to make the thing just look prettier. And you'd be surprised, when you can catch people's eye from the road, you're gonna get more traffic. When you can get more traffic, you're gonna get more potential tours and leasees. And when you can get more tours and leasees, you can end up with a much higher overall rent number, because you're just getting more people in front of it.
So how many units are here?
That's a funny question to ask, because normally I should just give you a straight up answer, 264. When we were going through our contract, the seller said, hey, there's 4 units that are completely down and you can't use them because we're using them as a maintenance shop. So I chewed out the selling broker and I said, hey, I was expecting to pay for 264 units, not 262, not 263, not 263 and a half. I need 264 working units. He said, let me get to the bottom of it. He calls the sellers, and they were so out of it. They were so checked out, which I can get to the storyline behind that a little bit, but they were checked out and they didn't realize that 4 units weren't even on the rent roll. And so technically we're buying a 268 unit with 4 down units. So we've got 264 that are rentable and another 4 that we can bring back online with about 20 or 30 grand of redoing and updating, but they'll also be brand new. So 268 total.
But does that mean that they're all, some of them aren't rentable, except you're going to have to put in more money? Like, do you pay per door, per square foot?
So we typically,
based on dollars?
Yeah, we typically get an indication of value from the broker, where they think this thing should land, and then we see if those numbers work. Then on a deal, we've underwrote 150 deals since October of last year. This was when we closed our last deal. So we closed our last deal, we started underwriting again. We looked at 150 deals, which represents every deal, new, old, within a certain range. So about 80 units or higher, and less than 600 units, somewhere in that range. We underwrote everything. And by underwriting, I mean, some of them we screened out. We had clear criteria, so I didn't have to spend a bunch of time underwriting a 500 unit brand new build. That's not what I do. Long story short, we get to a place where the deals that really matter, we dig in and we talk to our legal teammates, we talk to our tax accounting people, we talk to our people that do the property tax adjusting, our insurance, and we really dig in. And at that point, we've tried to figure out, is this price gonna make sense? We'll talk to each other about it in terms of price per door, but we'll also talk to the brokers about total price. It kind of doesn't matter. It's not about price per door like buying a single family home. It's more about, does the income stream that you're buying match your business plan, match your purchase price? So they've all got to kind of make sense. Typically as a syndicator, we're trying to double people's money in 5 years. That's kind of a high level estimation of what we're trying to do. So if it doesn't work for our investors, it doesn't work for us.
So when you talk about basically doubling, that's a 20% gain.
Every
that's
year.
Huge.
Every 20, 25 times. We usually hold about 5 years, and that means that the project level, it needs to be even higher, right? And it means that you got to find a real steal of a deal. It takes a long time, a lot of digging.
And that's what you looked at, 150 different opportunities before settling on this one. Yep. That's a lot.
Well, the other part though is that we got buddies that are trying to sell these things, right? We're friends with the 15 or 16 important brokers in town, or at least somebody representing their offices, and they will call us and kind of understand when they should push hard on us for a particular deal because they know it fits our buy box. If you communicate a very clear buy box and you're not just like, hey, I want to buy anything, but you're like, I want to buy a 100 to 300 unit in these 5 little subsections of town, Irving being one of them, right? With a good school district and median income and at least 40% 2 bedrooms and 3 bedrooms. And then you keep going down the list of all your extra criteria of what we won't do. It needs to have, this type of electrical system, but we don't care if it has this type of plumbing system, et cetera, et cetera. Then you're gonna get a much narrower group of deals to look at. And the brokers are gonna push you really hard when a deal makes sense. This broker I closed with 2 years ago, Ford Brawley, he's amazing. And he knows what I want really, really well. So he called me and said, if you're not on the list of people that are trying to get to the very finish line on this deal, I'm gonna be disappointed. This is the deal you've been asking me for. And I laughed him off, and I first kind of took a look at 3 or 4 other deals that I was looking at. I finished my plate, right? I started underwriting some stuff, but I didn't really look at this one right away. And as soon as I did, he was spot on. It was exactly what we were looking for. I don't always trust just myself. So I've got 3 other friends that are amazing underwriters in town and 3 coaches. I brought it to all 6 of them and said, hey, am I missing anything here? A few of them had some points here, some points there, but at the end of the day, the numbers still made sense. So I was still able to provide our investors a 95% increase in their investment over 5 years on this. And I felt really safe about that because the location's so hot. It was exactly what I was looking for.
So with the 95, that's a little under target, but I'm guessing that most of them end up being under target with the goal.
Yeah. Well, I mean, look, there's a range there. I say we're looking to about double. If you gave me 100K and 5 years later, I gave you 195, almost every single one of my investors is going to be happy, especially if I can provide them a little safer, less risky opportunity than, let's say, going into the hood or going to maybe a mediocre area. And so I think, it kind of balances out. And our investors are looking for something that makes sense to supplement beyond just public markets, beyond stock markets, which, as we're recording this, we're seeing a lot of variability in the values of those public stocks. These private stocks or private opportunities, they do the same thing. They're all over the place. I mean, last decade has been amazing. The last 2 years of that decade, it hasn't been so amazing, but they don't run at the same speed. They're not doing the exact same thing as the public markets. So a lot of these are sophisticated investors with, either 6 digits or large 7-digit or 8-digit portfolios of investments. They need the diversification as much as they need the tax benefits and the 95% number. They kind of need to be able to have 7 or 8 different things that are providing them income versus just the one.
In terms of, now you've identified the property, is it under contract at this point, or are you still under an LOI?
Yeah, so the sequence of events, right? Brokers push it out there. They get about 100 people to download all the data. They sign a confidentiality agreement, and then you can start underwriting the deal. As you're underwriting the deal, you're going to determine if you want to even go tour the deal. So they'll maybe get 30 or 40 tours. I'm just making up the numbers here, but we'll just go funnel, right? Of those 30 or 40 tours, about half of those will probably submit an offer. So let's just say we were at 30 tours, 15 offers go out to the broker. The broker will review those, figure out who's serious and who's not, and invite the serious people to what's called the best and final round. Our team is pretty well known. We know what we want, and so we're almost always expecting to make it to best and final. If we don't get to best and final, we did something stupid. We probably went on a tour we shouldn't have gone on a tour on. But we always get invited to best and final, and in this case, there were 6 people invited to best and final.
Okay.
3 of those put their best and final offer in and were really close together. They were almost exactly the purchase price. We were the 3rd lowest of the 3, and they had very similar terms, although I would say we were some of the stronger in terms of confidence level and terms. But then they would do, as a final squeeze to try to figure out where to go here, they'll do a buyer interview. And so the buyers will meet with the seller directly in 15 to 30 minute conversations, and you got to present your case that you're the best buyer. A lot of things they're looking for is do they really have their CapEx budget down, their construction budget? Do they have a really good business plan? And do they feel confident when I talk to them about getting their financing and their equity and their plan rolling?
I'm confused. So is it more than just, I can close?
Yeah.
They actually care about more?
Now they care a lot more, because right now the temperature is that a lot of these people that are chasing deals aren't as serious. And so they'll get into the mix and then back out on a seller. When you get under contract and you're having a conversation with the seller and then you start changing your mood about it, maybe even don't do the deal at all, that messes their next part of the sale process. Like when they go back to market, it's not like a single family home where you drop out a contract and then you're going to get the same price you were looking for before. They're probably going to have to discount the price because operations have started to drop off, right? Or perhaps sellers aren't taking the deal seriously because they're going, well, what did these guys see? And so they maybe don't want to jump in with the diligence period like we would do in that first go round. So long story short, sellers are really scared right now that people are going to get under contract and back out. And that's why having a good track record of having 100% close rate, always being on point when it comes to doing what you say you're going to do, and not trying to hustle the sellers. Because I've been a seller, we don't like that, but also because it's not the right thing to do. It's a small community, We know how small our little crew is, right? And so when
everybody knows everybody.
Everybody knows everybody, and they will talk. And so if you're just you're trying to penny pinch over 20 grand on a $27 million purchase, you're going to be called out. Even when, you capture a moment that's buyer friendly, there will be a moment where it's seller friendly again. And so you just want to go and do things the right way, or at least, present a really strong, purposeful pitch to the sellers. And that's what we were able to do on this deal. We were the 3rd lowest price, but we got the deal because we had the most conviction.
So you actually weren't the highest offer. You were just the most likely closer.
Yep. That pretty much got it done for us on this one. These older properties, they got a lot of parking lot work. They've done a good job on landscaping and the trees. They got 34 buildings. 18 of them have roofs that are 2 to 7 years old. So they've done a good job replacing the roofs, but we're going to do the remaining. On this asset, we'll spend about 120 grand on this parking lot to fix asphalt issues, and then do an alligator cracking that happens. We're going to fill those cracks in, and then we're going to do a beautiful seal coat above that should last a couple of years and have it be completely new looking, and then have a striping company come through and paint a bunch of the restripe the whole asset. On the electrical side, it's 1970s guts. So they have replaced about 60% of these electrical meters, but the other 40%, I should say, are these very, frankly, outdated, and I'll even call them dangerous, federal Pacific breakers. So we've got Stablock, which is AKA the same thing as Federal Pacific. It's the name of the company. Stablock's the other sub brand that they put out there. These FP&Es, as I call them, they got to be replaced day one. We won't even be able to get a loan or insurance with these. It's changed a lot over the last decade. The sellers bought this 10 years ago from the University of Dallas. The university was in a position where they wanted to move away from this asset and build student housing across the street.
Okay, so it truly was student housing.
Student housing. This was part of the University of Dallas when they first built it.
Can I ask you this? Like, we've got a whole bunch of different meters. Yeah. You've heard sometimes you've got like 1 meter to cover
Master
all.
meter.
Exactly.
Yeah. This is individual. So
how important is that, or does it really make that big of a
super important.
difference?
You can't depend on your tenants to be responsible for the electrical bill if they don't have a way of measuring how much they specifically use. And so it takes a lot of the burden off of the ownership group and puts it back on the tenant, like you're used to, like most people are used to when they rent a newer apartment. They're all set up like this, but on these older ones, they actually used to just have 1 meter that gets read by the electrical company. And that means that the owners have to pay for it and then get reimbursed by the tenant. When you do that, you're not even getting 100% of your reimbursement. You're getting maybe 70, 80%. And so it's a big cost. It's a big headache. It's also just fairer. It's going to actually save the world 1 megawatt at a time, right? Because you're going to be able to, or 1 kilowatt, sorry, megawatt, kilowatt at a time, because you're going to be able to make people more responsible for how much they use. I mean, I'm the same way. If I'm in like an apartment, sorry, if I'm in a hotel, I might leave the lights on when I leave just so it's on when I get back.
AC's down to 68.
AC's at, exactly, in the summers. It's another thing we liked about this building. Come over here. This is concrete slabs, just like an industrial building would be built. Now, there are some areas within where they put up drywall, but for the most part, everything's attached to a really sturdy base. It's a very heavy building. We've got some fixing on a couple of buildings because it's also Irving, so we've got some foundation stuff to look at. But this thing will stay hot in the winter when you turn the heater on, and it'll stay cold in the summer when you turn the AC on, because everything's insulated. This very tight box with concrete. You're not leaking out a lot of the energy. So it's very efficient. We can get the bills down for people. And we love the way that it's built, because as a C-class asset, some of your tenants are C-class behaviors, and you might have a kid running around or a dog that beats up on your walls. You can't do that in this asset. Some of the interior walls aren't even made out of drywall, so you'd actually hurt your fist if you got mad and you punched the wall or something. So it's really sturdy, really beautiful build, and expensive. You couldn't recreate this. It would cost $315,000 per unit to rebuild this, and we're gonna get it for, I didn't talk about that, but we're gonna end up paying about $102,000 per door. Again, if everything stays fixed. During diligence, sometimes you find some things you need the seller to pay for, so I can see us landing on this thing anywhere between $100,000 and $102,000.
But that also puts it in perspective. You lose 4 units.
Yeah.
That's still $400,000.
Yeah. Well, the opposite. We gained 4 units. We thought we were buying 264. We found 4 additional. So, you got an extra 400 grand there. Yeah, it's an awesome find. Don't get me wrong. You still got to pay about $25K per unit. So maybe we found $75K a door. That's about $300,000, I should say, that we kind of found. But that was cool. I mean, it was unexpected. It's one of the few wins that you have. Most of the time you do these older assets for diligence, and you end up on the other side of it. You find some things you did not expect as you go into the plumbing, or as you go into the attics, or as you go into any number of the pieces of the asset.
All right, I want to ask you more about that. With the kind of the due diligence, and you talk about plumbing and electrical, and do you actually bring the professionals out here that they do their own inspection, or is this?
Absolutely, you have to. So on these projects, what I'll do, because I like to have as many professionals second guessing each other as possible, is I'll have layer 1 be a third party diligence company. There's 2 in town that I absolutely love, and whenever one's available and the other's not, I'll just go with whichever one's available. But we have 2 great third-party due diligence companies, and these companies go unit by unit, and they provide all of the trades that need to get on top of the roof, that need to check electrical, and they'll provide you a report. It takes about 7 or 8 business days to get the report done, after maybe 2 or 3 days of the visit. So you got about an 11 day period where you've got to wait to get the feedback and get specific numbers. But we're 2 days into that. So I've got about another 8 or 9 days before I get all the details on what's wrong from them. Because I'm slightly impatient, I like to be here for the whole thing and hear it from the horse's mouth. If they found a problem, I'm going to know about it within an hour because I'm bouncing around talking to each of the tradespeople from that third party person. In addition, I love their people from these two groups, but I don't trust them entirely. Sometimes they get in a groove where they get a little lazy and they won't dig into every outlet and switch if they're the electrician, or they won't dig into every pipe if they're the plumber and they couldn't find the clean out. So I like to invite my own second set of eyes and third set of eyes and leave diligence, which is, 30-day period. I like to leave with at least 3 bids from every single big project, and really even every small project. And we've got like a little tiny bit of pool stuff that needs to be done. I'm still gonna have 3 people take a look at that just in case. But yeah, this is where it gets really fun. It's also an opportunity for you to get maybe a highly professional team that can write you a beautiful report so your investors are confident that you looked at everything, and your lowest cost mom and pop plumber that's actually going to do the work, and you get to compare their bids against each other and decide what makes sense for the asset. So we do a lot of cross bidding and have people come and knock it out on day, we'll call it 1 through 14, and then we'll get the numbers back a week later or so and be able to make all the decisions we need to do before we leave our diligence period, which we should talk about, right? I know we were steering away from legal, but yeah.
And we're ignoring legal entirely. We'll get there.
I love it. My lawyers say we'll ignore the legal entirely. This is great.
Well, this is a ton of information. Wait, and we're going to dive in a little bit more about the process internally, the inspections, looking at units, looking at leases. And until then, check back in.
Thank you. That was fun.
Thanks for taking a little bit of time to learn more about how to do due diligence and what to look for if you're syndicating or buying real estate properties that are large, using investors, making sure that you're doing things right every step along the way. And watch the next video where we're actually going to do a walkthrough of one of these units, so we dive in even deeper into what to watch out for to make sure you're making good decisions.